Kpler, the energy analysts who predicted 2024 oil prices within 45 cents, warned us that $114 oil was just the beginning, and their predictions are coming true in the most dramatic way possible. The Strait of Hormuz remains effectively closed. Oil prices swing wildly between $90 and $120 per barrel on NYMEX and ICE exchanges. And the experts at Kpler, who accurately predicted oil markets within 45 cents in 2024, are now painting a picture that should terrify every consumer and investor watching. Let me tell you exactly what's happening and why this crisis is different from anything we've seen before. Kpler isn't some fringe analytics firm making wild predictions. This company was founded by engineers Francois Cazeur and Jean Meunier in 2014, starting literally in a kitchen and growing into a global powerhouse with over 750 employees across 35 nationalities. They've been profitable from day one, and their track record speaks for itself. When they predicted 2024's dated Brent oil average would be $81.10 per barrel, the global benchmark for physical crude oil pricing, the actual average came in at $80.65. That's a margin of error of just 45 cents on a multi-trillion-dollar global commodity. But here's what makes their current warnings so chilling. At the start of 2026, these same analysts expected oil to hover around $60 for the first half of the year. Everything changed on February 28th when US and Israeli forces launched strikes that killed Iranian Supreme Leader Ayatollah Ali Khamenei. Amina Bakr, Kpler's head of Middle East and OPEC Plus research, has been watching this unfold from Dubai. She's the former chief OPEC correspondent who won the 2023 OPEC Award for Best Journalist. And she's been tracking every barrel that flows through the Persian Gulf for years. Her assessment is stark. The only thing that could really turn this around is the reopening of the Strait of Hormuz. The Strait of Hormuz isn't just temporarily disrupted, it's effectively shut down. And with it, about 20% of global petroleum consumption that normally flows through those waters. We're talking about more than 14 million barrels of crude oil per day, plus another 5.5 million barrels of refined products. That's not a number you can just replace overnight, even with Saudi Arabia's 5 million barrel per day east-west pipeline to Yanbu and the UAE's 1.5 million barrel Fujairah pipeline terminal bypassing the strait. Muyu Xu, Kpler's senior crude oil analyst based in Singapore, puts it bluntly. Escalation could push prices beyond historical highs, especially if major oil fields come under attack. That escalation is exactly what we're seeing. On March 8th and 9th, fresh waves of strikes targeted key petrochemical infrastructure, including the Shahran oil refinery in northwestern Tehran. Oil prices hit $120.45 per barrel on March 9th, levels not seen since the peak energy shocks of 2022. What makes this different from previous oil crises is that the market has entered what traders call extreme backwardation, where immediate oil deliveries are trading at a record $14.20 premium over next month futures. That's desperation pricing. Buyers are paying almost any price for oil they can get right now because they're not sure they'll be able to get it at all next month. The opposite of backwardation, called contango, occurs when future prices exceed spot prices, indicating oversupply. We're nowhere near contango right now. This backwardation is particularly severe at Cushing, Oklahoma, the delivery point for WTI futures, where storage tanks are being drained faster than they can be refilled. Michelle Bruhard, Kpler's head of policy and geopolitical risk, delivered perhaps the most sobering assessment. Global oil supply will remain tight for a very long time, even after production resumes. She's calling high oil prices the Achilles heel of Trump. And when you see gasoline prices in the US jumping from $3 to $3.48 per gallon in just 1 week, you understand why. The numbers behind this crisis are staggering. About 9 million barrels per day are currently off the market because facilities have been hit or producers are taking precautionary shutdowns. Iraq and Kuwait have already begun shutting in production. The UAE is likely next, according to Societe Generale analysts, possibly within 5 to 7 days. Even Saudi Arabia faces potential shut-ins if the strait remains closed for 2 to 3 more weeks. Now, you might be thinking, what about those strategic petroleum reserves everyone talks about? The US Strategic Petroleum Reserve holds 415 million barrels, about 58% of its total capacity. The International Energy Agency's 32 member countries collectively hold about 1.2 billion barrels in strategic reserves. That sounds impressive until you do the math. The US can release a maximum of 4.4 million barrels per day from its reserves. Even if the IEA coordinates a massive release of 300 to 400 million barrels, representing up to 30% of total reserves, Baker's analysis cuts through the optimism. No matter how much spare capacity in the strategic reserves, it's not going to fill that gap. That gap is just too big. OPEC Plus tried to help, announcing a 206,000 barrel per day increase on March 1st. Jorge Leon from Restad Energy called it what it is. If oil cannot move through Hormuz, an extra 206,000 barrels per day does very little to ease the market. Logistics and transit risk matter more than production targets right now. The insurance crisis alone tells you how serious this is. Lloyd's of London war risk syndicates and other war risk insurers are cancelling policies for vessels moving through the Gulf, and premiums have jumped 50% overnight. We're talking about costs rising from $250,000 to $375,000 per voyage for a $100 million ship. When insurance companies won't cover the risk, you know the situation is genuinely unprecedented. What's particularly unnerving is how quickly this escalated. On February 27th, oil was trading around $70 per barrel. Within days, it hit $120. By March 5th, Brent had jumped 15% in a single session to $83, then kept climbing. On March 9th, WTI posted its biggest weekly gain in history at 35.6%, while Brent jumped to $108.20. The ripple effects extend far beyond oil. Iranian attacks on Qatari LNG facilities took about 20% of the world's liquefied natural gas supply offline. European gas prices nearly doubled. Even fertilizer markets are in chaos, with up to 30% of world fertilizer exports normally passing through the Strait of Hormuz. Neil Atkinson, former head of oil at the International Energy Agency, captured the gravity perfectly. We are in a potentially game-changing and unprecedented energy crisis. This isn't hyperbole from someone trying to sell newsletters. This is the assessment from someone who spent years managing global energy security. The appointment of hardliner Mojtaba Khamenei as Iran's new supreme leader, replacing his father who was killed in the initial strikes, signals this crisis isn't ending anytime soon. An IRGC advisor has stated that oil price will reach $200 in the coming days. While that might be extreme psychological warfare, the underlying supply conditions make even $150 oil plausible if this conflict continues. Simon Johnson, MIT economist and 2024 Nobel Prize recipient, laid out the mathematical reality. The Strait of Hormuz has to be reopened. It's 20 million barrels of oil a day going through there. There's no excess capacity anywhere in the world that can fill that gap. That's the brutal truth behind Kpler's warnings. When they said $114 oil was just the beginning, they weren't being dramatic. They were doing math. The global oil system was built around the assumption that the Strait of Hormuz would remain open. Remove 20% of global oil flows, add production shutdowns across the Middle East, factor in insurance and logistics chaos, and you get a crisis that makes previous oil shocks look manageable. The IEA has activated its emergency response mechanism only 5 times since its founding in 1974. The first Gulf War in 1991, After Hurricanes Katrina and Rita in 2005, during the 2011 Libyan crisis, and twice following Russia's invasion of Ukraine in 2022. Each time the disruptions were temporary and geographically limited. This time we're looking at the potential permanent restructuring of global oil flows through the world's most critical choke point. When Kpler analysts warn that $114 oil is just the beginning, they're not predicting the future, they're reading the present. The question isn't whether oil prices will go higher. The question is how much higher they can go before something breaks in the global economy, and how long it will take to build a new energy system that doesn't depend on a 21-mile wide strait controlled by countries at war.